This is a HubPay Media original.
The contents of this podcast are for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
Hi everyone, I'm excited to welcome Mark Fried, who is joining us from Dallas nearby. He's the co-founder and general partner of Stormbreaker Ventures, which is an early stage venture fund that partners with high velocity, high conviction companies that stand out from their peers because they are driven to build efficiently. Hi, Mark.
Ash, it's an honor to be with you today. I feel so lucky to be with you and look forward to this the discussion.
Thank you so much. I'm really excited as well. And I'm sure our audience is also going to be super excited to learn more about what you're working on. You're at the frontier of innovation. And so I would just go ahead and start with the first question that I've prepared for our interview today. So according to PitchBook research, the vast majority of private companies unicorns, about 112 of 147 to be exact, had no top funds in their first round. And that means that most micro funds, such as your funds, are the biggest winners who get in early and enjoy the billion-dollar exits. And you really help to discover them and grow them. And that's good news, obviously, for Stormbreaker Ventures. You currently have an AUM of about 15 million. So tell us more about this, running a micro VC based off Silicon Valley.
Yeah, well, we certainly hope to have amongst our portfolio companies several unicorns, and we're very optimistic that a lot of the investments that we've made certainly have that potential later on as the companies evolve down their progression. But certainly to get to that point, we need to have very robust deal sourcing, but on top of that, we need to have even better investment selection. And so we spend, like many VCs, but I would say even greater, it's a very, very robust screening process that we go through in a very rapid period of time. Stormbreaker was really founded and designed to be the anti-VC VC. Mm-hmm. And when I say that, let me unpack that a little bit. Our partners, both our full-time partners and our venture partners, all come from backgrounds where we've all raised outside capital. And many of us were not really enamored with the process. We thought that there was there's just a lot of egos, sharp elbows, politics involved with raising capital, predominantly in the Bay Area, but outside the Bay Area as well. And so we designed Stormbreaker to kind of be the best of both worlds. We want Stormbreaker to have the deep bench, the resources to be able to roll up our sleeves and help founders build their companies, have that deep bench, but have the quick trigger pull and the ability to process information quickly based on where the stage their company's in, what their true capital needs are, not necessarily what they think they want to raise. Because the worst thing you can do as a venture capitalist is spend months and months and months going through diligence, discovery, customer reference checks, and then at the conclusion of a multiple month process, come back and say, wow, you guys aren't the next Facebook. And that, a lot of founders become very turned off by that process. And so we try to speed up that process while still performing as rigorous a background as possible. More specifically to unicorns in early stage, I think, a more recent trend is that the larger funds have come back into seed rounds. But prior to that, over the last few years, really, the big funds had really focused on the Series A, Series C, growth rounds, really where they're hitting the gas and accelerating that growth right after product market fit. We've really focused, as I would say, to use a bad golf analogy, the middle of the fairway for us is seed rounds. So we don't typically or very rarely invest pre-revenue, but we really are trying to establish during our initial screening process that product market fit. If they've got that product market fit and some early traction and they're coachable and a desire to grow and scale, we're here to help. We're here to help with capital. We're here to help with people resources, and we're here to help with a shoulder to be there for founders. We like to say, when you have your worst day business-wise, we want to be your first call. And I think that resonates with a lot of founders because they view their investors and the investor process, as enjoyable as going to the dentist. So for them to have that comfort, for them to call us to be their first call to help process what's happened to them and figure out a plan to move forward, it's what we focus on. So,
wow, we need more VCs like you. I sound like more like a good friend when you need, and as you said, many founders have been really turned off by dealing and approaching VCs because it's a very cutthroat environment, and they really authentically feel like you're a great partner for them. So I'm sure it provides like great access to opportunities, given also the reputation you've built in the ecosystem to get into very competitive rounds as well. That, even with smaller tickets.
I think, when we start talking with a founder, even before we invest, we just evaluate the situation and where they are. And we dig and comb through our network of resources and people that we know from our, decades of experience and say, how can we help this person or this team right now, regardless of whether we're going to write a check, not because there's anything in it for us, but because it's the right thing to do. And I think that, in particular, we've been able to get into, as you mentioned, a lot of oversubscribed rounds, where founders have actually made room for Stormbreaker because they see that value. We've had comments from a couple of portfolio companies have come back to us and said, we've never had a VC just start making introductions after a first call for us, versus well down the road or after they've written a check. And we think that, regardless of whether we make a decision at this time to invest, that just builds goodwill, both for later, if we decide to make an investment later, if it hits our metrics, and as deal sourcing is everything in venture, they refer us to their friends. Yeah. And we think that founders referring founders is a key tenet of our deal sourcing, which we consider as proprietary. So a reference from another founder that they've had a great experience or a good experience with Stormbreaker, regardless if we've invested or not, it is everything to us. Reputations take a long time to develop and a moment to ruin. So we're very, very focused on reputation.
Yes, absolutely. And I must say that you also have a unique background. Traditionally you worked in the oil and gas industry. You had a great exit back in 2011, if I remember.
2012. Yeah.
2012.
Yep.
And since then you started doing your own angel investments, and that's kind of what also led you to become more of a professional venture investor, partnering with Stormbreaker. And tell us more about it. How you if we go back to the early days of you making the first checks into startups, do you even remember what that period?
I had no idea what I was doing. No clue. And I think, just like I think, try not to draw this analogy too closely, but people learn lessons by playing poker. They learn very expensive lessons. As an angel investor, you learn very expensive lessons, and typically they come very quick. But I think, the interesting thing, and you mentioned it, I come from a much different background than, going to school in the Bay Area, going and working at a VC firm or working at a software company. I think the interesting thing is the problems that come up or the challenges in business, they're exactly the same. It's just a different set of circumstances and a different set of people and roadblocks that you have to figure out a way to scale over that wall. So I think, amongst our partners, I bring that a little bit different perspective as a non-tech perspective. I also think that the industry and the industries that I've had exposure to are ripe for disruption, but they're going to be the last to accept technological innovation via software. So it's going to occur. And I think that the particular companies that are able to gain traction within the natural resources industry, both traditional renewables, as well as industrials and various services affiliated with that, the companies that are able to break through are going to be big winners versus a larger subset of companies. Mm-hmm. So we're clearly on the hunt for to partner with the founders focused in those areas.
Yeah, and those industries don't want to end up like what happened with Kodiak, right?
Correct.
The case study
Correct.
we learned in the university. So yes, adapt to the innovation that you can't, fight it. It will come back at you. So great insights into your venture world. I know you guys focus specifically on investing in capital efficient companies, but overall you're agnostic. You can invest pretty much in any vertical. So I'm curious, you're a team of 3 GPs. How do you, don't you need expertise in each vertical when investing? How do you overcome those, issues, when you can't never know anything about everything?
Yes. Yeah. Well, we are generalists, both industry as well as geographic. And we're very proud of that. And I think going back to a statement I made earlier, we're a small group of partners running an emerging manager, but we've got a very deep group of unofficial and official advisors that serve various purposes to the fund. So I think given the fact that each of us have operating experience, owning businesses, founding businesses, exiting businesses, we've just built up networks within the various spaces over time that we can tap into to go back to and say, hey, what do you think about this? Is this something that you really feel like has that unique ability to gain traction and to scale? And I think that, also geographically diverse, we've been able to not only build deal sourcing networks within each of these various geographies that we've invested in, but we've also been able to develop, large amounts of founder and other fund relationships that are specific to different geographies that know that when they bring Stormbreaker in to evaluate a company or to look at whether or not to make an investment, not only are they going to give we think, a good look at that business, but also that we're a really supportive, good partner. Because of our size, we've never really served up to this point as a lead investor, leading a big syndicated round. We have aspirations to do that, but we haven't done that to date. But I'd classify us as kind of the best supporting actor or actress in a TV series. So we're very friendly capital. And so I think that, other funds that are leading big rounds that are looking to fill those out, they know that in addition to obviously a check as well as, future checks as companies continue on their evolution, we're really there to help and roll up our sleeves and collaborate.
Oh, great. So why did you decide to specifically focus on capital efficient companies? Because there is this funny joke or stereotype about, especially in Silicon Valley, all these tech companies, it's all about just raising money. Mm-hmm. But not as much about how it's being spent or, what revenue and income are generated. So your approach is a bit different in the space. Can you talk a little bit about it?
Sure. We're very focused on capital efficiency. We believe that the use of proceeds from any outside capital or their own bootstrapped capital that they've raised within their company is a clear indicator of how the business will progress and evolve over time. So let me just kind of unpack that for a minute here. So we want to see companies that want to raise $1 million of capital to generate $3 million of annual recurring revenue, mm-hmm. not necessarily the inverse of that, right? Mm-hmm. They need to raise 3 to get to 1, while that's still a relatively middle of the fairway metric for venture companies in the early stage. We want to see that inverse. So we like scrappy, founders that have a chip on their shoulder. We typically invest in founders where it's not their first time founding a company. So, we like second, third, fourth time founders. In a lot of cases, they've, let's say they've not necessarily had the exit that they desired, that they either left something on the table or they were not enamored with the process upon their exit. And so we know that they know that every dollar they raise is their precious capital and their investors' precious capital. We also feel like capital efficient companies understand that when you take outside capital, you're becoming a fiduciary. You're representing not only yourself and your own interests, but you're representing an outside investor who's, made that promise to their investors that they're going to be a fiduciary. And so
that says a lot about you, because you're
yes.
also acting as a fiduciary to your LPs. And it says a lot.
We really struggle with companies that present a raise and then 6 months, 9 months later is their runway, and that they have to raise the next round. We really want to see that path towards profitability. And by profitability, we mean EBITDA, break even, or positive, particularly, which is difficult in the early stage, but it's hypercritical, and it will set the tone later on for how they'll be able to attract future investors. So we also, are very focused on sort of the pro forma cap table after the round, and making sure that founders have a meaningful ownership percentage coming out of that round. Because the last thing we want to do is invest in a round where, particularly in the early stage, the founder owns, say, less than 20% of the company. We want them to be everyone's interests aligned, and to be a meaningful stake for them. So we focus on these things. We focus on capital efficiency, and it's served us well so far. So we're going to continue to go with it.
Oh, it's good, because there are some predatory VCs or greedy VCs out there who just take advantage of founders that need a lot of help. And they would say, look, I'll write you a check, but I want 10% of your company just for my advisory role. It's nice to see how you are founder-centric. And it's also maybe because when you invest, you primarily first invest in the founder, and you want to.
We have the way we run our firm, we have a group within the three partners, if you will, a lead person, and that lead person focuses on what we call founder success. Okay.
Nice. I love it. I haven't heard that.
Yeah. We view founders as our customers, which is, I think, a little bit of a different perspective. So we're constantly trying to ensure that our customer believes that we as a service provider is first class, best of breed. We view our LPs as our business partners in that methodology. So I think it's interesting in that our LPs typically will get a call from us based on their background as partners, and we kind of view them as unofficial advisors as well, experts in their field. So founder has an issue come up. As our customer, we're trying to help out our customer. We'll bring in not only our advisors that are not necessarily LPs, but LPs as well to help. That's how I got involved with Stormbreaker in helping Saeed and Andy, my partners. I started as an LP in the fund. So this started out as a passive investment. Really wanted to get to know, or not get to know, but really get more experience in early stage and working with founders as a former co-founder myself. And as time went on, and I got to speak to a lot of the companies that Andy and Saeed were looking to partner with, it made natural sense for us to join forces and really build out this firm. And so I think we come from a different perspective, and so far so good. And we've got large aspirations as a firm.
Beautiful story. And it's the diversity bonus, right? When you come from diverse backgrounds, it all adds
absolutely
up to be more. So since inspection, your fund has already generated really impressive unrealized returns. The fund is still going on of 5x to as much as 20x. Wow, congratulations. And these are still early days. Could you share more about some of your fastest growing companies, such as Contact Book, HubPay, and Karma Check?
Sure, absolutely. Well, so we've made 42 investments in individual portfolio companies to date, beginning in the latter half of 2019. So COVID and the COVID period was certainly, very, very difficult and awful for a lot of people. I will say for those of us in venture investment, in particular, I think we had the opportunity to invest and back founders, perhaps that we at reasonable company valuations that we may not have had that opportunity in a more normalized environment.
Right.
I think there were very forward-thinking founders that said, we need to build an arsenal, a war chest of capital here to be able to weather factors outside our control.
It's interesting because, yes, at the beginning of the pandemic, everyone freaked out, valuations dropped. Everything looks like it's, what you buying cheaper and makes more sense. And now everything is just like overvalued. So what do you think has happened in this period that suddenly
Yeah,
it's just totally
I think that there's just been so much capital that's flooded into this space. And candidly, it's rightfully so. We believe that we're in the very early days of software, and our fund focuses largely on predominance of software businesses all throughout the enterprise, whether that be SaaS, network services, cybersecurity, et cetera. Stackable, repeatable revenue really being our focus. But we really think, we're in the bottom of the first, top of the second inning for software at this point. The world is so ripe for continued disruption. There are so many problems that are left to solve. And as such,
Right.
capital has just flooded into companies like ours that shepherd early stage investments. Back to your comment about some of our early success stories, at least based on the paper markups and where they've raised subsequently. Of the 42 investments that we've made, about a third of those have raised subsequent rounds after us. We've actually had 2 companies that have had successful exits in the short period that we've been, investing as a fund at very, very large returns, outsized returns. So we're very pleased about that. But several of our companies, we believe, are well on their way to unicorn status. And I'll start you mentioned a few. Let me start with Contract Book. Contract Book is a company led by a brilliant founder, Niels Brockner, based in Denmark. And it is a full suite contract automation tool for small and medium-sized businesses, whether those be professional services firms or just small business enterprises. And a contract administration is a choke point within business. Typically, there's multiple people within entities as they get bigger to administer contracts. There's typical trigger points, both positive and negative. And this software enables automation of that process to be able to help workflows. They've had huge amounts of early success. We invested in early 2020 in Contract Book alongside Gradient Ventures, which is the venture arm for Google focused on AI. And subsequent to that, they quickly raised a very large Series A, and 4 months after that, a very large Series B. And they today have over 100,000 users of the software. So just a brilliant piece of software and company. They built culture at that business, first-class culture within their employees in Europe and Scandinavia. And now they're expanding. They've opened up an office in New York, and they're scaling in their go-to-market in North America.
And it sounds like soon perhaps they're going to be unicorn and maybe double unicorns, because how many big tech successes are there in Denmark?
Yes. Well, we certainly don't want to get ahead of ourselves, but we're very optimistic. We trust and believe in the team, and we're thrilled to be partnered with them. So just kind of moving on through the names that you mentioned, HubPay, again, another fantastic company led by one of the most scrappy, capital efficient, dynamic founders that we have that we've partnered with, named Kevin Kilty, who's based in London. And Kevin, who had spent time working in large part in a lot of the large banks in London, saw this unique development in the UAE, in Dubai, whereby there were a tremendous amount of non-resident workers who were coming into Dubai and were sending money home via remittances to undeveloped countries, and in particular small towns and villages where their families may never have even had a bank account.
Wow.
And so Kevin and his team established a presence in Dubai, obtained one of only 2 licenses to be able to send remittances back, in this case to Pakistan, which is the first of many markets that they plan to open up that bridge or that network, if you will, of payments. And in addition, so the volume of transactions that have grown via these remittance payments is tremendous. I mean, I think we were looking at it the other day, and it started with roughly $700,000 in total that was moving in January 2021, and that has now eclipsed $20 million plus per month. So rapid growth. They just raised their Series A about a month ago, led by a fantastic firm that we've partnered with on a number of different investments. And the sky's the limit there. The sky's the limit, not only in remittances, but to introduce all types of financial services to folks that would never have these opportunities had it not been for a worker making that life decision to come to Dubai and work and send money home, but be able to utilize HubPay and the digital wallet that we say is being developed there. So we're really excited about HubPay. We think there's tremendous potential there. And again, it's all about the team and the execution. So very thrilled to be involved with that company.
Oh, great.
And lastly, just to continue on with the 3 that you mentioned, and one that we're also extremely proud of, and that's Karma Check. And this is if anyone is, in your audience has gone through a pre-employment screening process prior to going on as a new full-time employee in our, or even recent in our great resignation economy that we call it right now, disrupting the background check and even ongoing employment screening process, if you will, is incredibly ripe. And not only from the employer's side, but providing sort of that beautiful dynamic, transparent process for the employee who's being screened. And so Karma Check was founded by a team led by former founder of LinkedIn, Eric Lai, as well as Shaunak Mali, and several other partners. A fantastic company, great early traction, large list of rapidly developing enterprise customers to speed up the background check process, to provide that visibility so a candidate knows exactly where they are in which stage of the process, largely via mobile application. And then reduce costs because as someone that's used background check or pre-employment screening companies, the cost is significant. It takes a long time, and sometimes even the information isn't accurate. So the Karma Check team is focused on really efficiently improving each of those various areas.
Wow, I love all these companies.
Yeah.
Congratulations
Thank
for
you.
picking such amazing winners. And we look forward to hearing more about their success stories as they progress. And you said you were very modest to say that you invest in second or third time founders. And now we are like, oh yeah, they founded LinkedIn. Oh, they founded Google. And yeah, that's great. Teasing you. But yeah, actually, speaking of that, I have a friend who's the founder of a really successful Israeli technology company. And he said, Ash, you know what? My investor told me that for him, it doesn't matter if he loses the money on the investment, he will keep investing on the next ventures too, because he believes in me. And at the beginning, I was a bit surprised because if you lose money, you probably never want to do it again, try it again. But I guess, it's all about believing in the people and trusting them and feeling like they're going to do extremely well and you want to grow with them. And it sounds really amazing, all of the journeys that you're experiencing with them.
Yeah, ventures, it's a very difficult business in the sense that you're faced with a lot of decisions that have to come relatively quick. In a lot of cases with people that you may have only began to interact with. In some cases, it's a relationship that's developed and built over a long period of time. But there's so many factors involved that can lead to both the success and failure of the business. Any venture investor that tells you that they don't have either failures or lack of success within their portfolio is just simply not being truthful. Right. And so, as evidenced by what's going on right now in our country or in the U.S. with supply chain challenges and very, very difficult labor markets, those types of things are to a large degree outside the control of the founder. So we just like to be as involved as we can and as they are as much as they are comfortable with, to be able to say, look, each of us have been through various business cycles, lots of difficult times ourselves in various different business interests. We've tried our best and done our best to navigate our way through them. So as long as, a founder is both self-aware, honest, and communicative, we can help. If they kind of go into a ball and try to and kind of hide off information or become uncomfortable with sharing information because it's bad news, that's a challenge. We ask, like we said, we ask our founders, if you're having your worst day, we're happy to take that call because we've likely been there in what you're dealing with. So, and it's served well so far.
It's great approach. I love it. So you will have the final close of your first fund next month. Congratulations.
Thank you.
Mazel tov.
It's been a long road.
Yes.
Very long road with your great help.
Paid off.
Yes.
Really, I'm
Yes.
glad. I'm glad. It's been an honor to meet you pretty much after launching the fund, and I'm really, really excited for you guys. And you will be launching Fund 2 sometime this summer. So, what's the plan? What are the plans for the next fund? How is it going to be different or similar to this one, the existing one? And what are some of the lessons learned from being an emerging VC manager?
Yeah. I'll start with Fund 2. We're very excited about the potential of launching Fund 2, as you mentioned, sometime this summer. We believe that the approach that we've taken, both a number of portfolio companies, has worked. We believe it gives us sort of a great ability to provide a diversification of both industries, geographies, types of businesses. We really feel like that's the way to maximize returns because, as you mentioned, the startup business is dynamic and evolving, and there are so many early stage funds competing to get involved with companies. The larger funds are coming back to the earlier stage now. They've been gone. Sometimes they come back. It's a unique and challenging environment. And so, but we also think that potentially being able to provide larger amounts of capital, take more meaningful ownership percentages in companies, will serve the company better and will serve us better as well in terms of having that meaningful voice. So the average check size where that might have been to start in the low to mid 6-figure range, that might on a median or average basis be in that mid 6 figures on average. And so our focus is going to be on raising a larger fund, but staying with what we know and staying with who we are. We're looking at adding a fourth partner, full-time partner. We've added a venture partner who's kind of part-time with us as well, somebody that brings 30 plus years of experience of as a CEO within a large telecom, who's joined us recently. And so we're really excited about what the future holds and what Fund 2 could look like.
Wow, congratulations.
Thanks.
Wow, guys, I hope you had a fascinating time with us and with Mark and sharing with us all of his wisdom and sincerity. And please, Mark, let us know, or our audience, how can they get involved in any way?
Absolutely. I direct all of your listeners to take a look at our website, which is www.stormbreaker.vc. And if you're a founder and you happen to be listening to this podcast, and we'd love to talk to you. So please, you could reach out to me at mark@stormbreaker.vc, and would love to hear from you.
Thank you. Thank you so much.
Thanks so much for having me. I really appreciate it.
Pleasure. And we look forward to seeing you soon, the next episode. Bye.
Thanks for listening. You can find more episodes and all of our other Hot Pie Media originals baked fresh daily at our home online at hotpiemedia.com, the Hot Pie Media YouTube channel, or wherever you listen to podcasts.